everyone, welcome back to Corporate Decoder, the place where we dust off those boring SEC filings and find the good stuff. Today we're diving into Stone Point Credit Income Fund's annual report, and let me tell you, with the amount of accounting lingo in there, it will feel like trying to read a map in a foreign language. But trust me, we'll try to make sense of it all. This report paints a picture of a company trying to make its mark in a pretty turbulent financial landscape. We'll try to unpack their investment strategies, sniff out the risks, and see if this is a worthy investment or fool's gold. Stone Point Credit Income Fund, they call it, or the fund as they like to refer to it, was set up as what's known as a business development company. Think of it as an investment firm that lends money to smaller companies that might not get loans from regular banks. It also wants to be a regulated investment company, or RISC, which is a special tax status, allowing them to avoid paying corporate income tax if they pass most of the profits on to the investors. The fund's main goal is to make money now, with a little bit of capital appreciation later. They plan to do this by investing most of their funds, at least 80% of their total assets, in what they call private credit investments. These are basically loans, bonds, and other credit deals that are not publicly traded or are issued by private companies. They expect most of these investments to be privately negotiated loans directly to private companies in the United States. The company cares about environmental, social, and governance, or ESG factors, but there's no guarantee they can find all the ESG risks while still investing in companies that make money. They aim to avoid businesses like payday lenders, strip mining, and anything related to marijuana, and so on. The fund highlights its market opportunity and the ways it beats its competitors. First, there is increasing demand for debt capital. Second, they have a proactive sourcing and relationship-driven deal flow, meaning they go out and find deals through their connections instead of just waiting for them to appear. Third, a disciplined underwriting process to make sure the deals make sense by looking at the borrower, the loan structure, and whether there is any financial support. Finally, the fund has a team that is experienced and focuses on a few specific sectors. This specialism helps them be experts in their field. Let's talk about the team calling the shots, the Credit Investment Committee. It is comprised of Scott Bronner, James Carey, Eric Rosenzweig, David Wormuth, and Nicholas Zerbib. These people have backgrounds from private equity to banking. Charles Davis and Stephen Friedman also serve as advisors to the Credit Investment Committee. What's interesting here is the advisors, especially Stephen Friedman. This guy was chairman of Goldman Sachs, served under President Bush, and even chaired the Federal Reserve Bank of New York. That's a lot of experience on the table. Now, who's actually running things day to day? That would be the advisor, who, under the investment advisory agreement, makes most of the investment decisions. There's a fee for that, of course, known as the management fee. Then there is the incentive fee, where the advisor gets a cut of the profits, which they call incentive fee, but there are, of course, a few catches. The fund pays the advisor 1.25% of the fund's net assets each year, but they are waiving 0.50% for the first 3 years. This means the management fee is really 0.75% for the initial 3 years, but later it will get back to that 1.25%. Then the advisor gets an incentive fee, which can get a bit complex. Basically, after the first year, the advisor starts getting a percentage of the profits, but only after the fund has met a certain level of return. It is like a hurdle. On the other hand, there's an expense support and conditional reimbursement agreement, which is a way for the advisor to pay for some of the fund's expenses. If the fund does well, they have to pay the advisor back. The fund intends to make monthly distributions. It is like getting a regular paycheck from your investments. They also have a opt-out dividend reinvestment plan. So that means if you do nothing, the distributions will automatically be reinvested in the fund to buy more shares. One of the first risks is that the fund has limited operating history. Past performance doesn't guarantee future results, especially because the Stone Point funds may have managed different investments than are being managed today, and the company doesn't have a lot of experience managing a business development company. The success of the fund hinges on the advisor and the investment team. Any loss of key people could really hurt their results. Legal, tax, and regulatory changes could occur that may adversely affect the fund at any time during its term. So it may be difficult for the fund to continue to operate as a BDC. Finding and setting up investments is tough and uncertain. The advisor faces competition from other investment groups and is subject to market conditions and government rules. Another issue is that the shares can't be easily sold. There is a real risk that it loses its status as a BDC, which could lead to restrictions and lack of flexibility. And finally, to be treated as a regulated investment company. Or risk, they have to pass along generally at least 90% of the sum of their investment company taxable income and net tax exempt income for that taxable year to shareholders. There is also a quick mention of compliance policies. This is a public company, so they must be in compliance with Sarbanes-Oxley Act of 2002, or SOX. There are extensive descriptions of tax implications, both for US and non-US shareholders, worth reading closely if you are investing into the fund. The fund needs to keep at least 70% of assets as qualifying assets. These include securities from smaller private companies or small public companies. Another paragraph here about proxy voting policies and procedures. Shareholders can find out how the fund voted on certain issues by contacting their investor relations department. Towards the end is the discussion of the Board of Trustees and the Audit Committee. The Audit Committee is in charge of monitoring the company's financials. Alright, let's jump into those financials. Let's start with the assets and liabilities as of the end of December 2024. Cash was only at $26,001. Deferred offering expenses were over $588,032 to be exact. Then total liabilities, which were mostly organizational and offering expenses payable, were at $1,142 tail allocation $42,029, leaving a total net assets at only $1,000 and at only $1,022. As in 8029 eyes, leaving a total net assets at only $1,042,829, leaving a total net assets at only $1,042,829, leaving a total net assets at only $1,000. The consolidated statements of operations tells us that investment income was only at $1,000, which tells us that the company is very early in its life cycle. With expense support of $519,021, they are left with a net investment income of $0. Finally, we can see the fund issued some shares to have a total net assets of $1,000. The auditor is KPMG, selected by the Audit Committee. For their services in 2024, KPMG got paid $35,000. For the final note, none of the trustees or executive officers terminated any trading plans during the fiscal quarter. So after diving into this annual report, what's the real story? The fund has high ambitions, but it is very early in its life cycle. It needs to carefully manage its finances and face a real risk of default. This investment has several risks, particularly its limited operating history. However, Stone Point Credit Income Fund is in an attractive sector and has an experienced team leading the investment activities. Thanks for watching Corporate Decoder. I hope you found this video useful. Don't forget to like, comment, and subscribe.